G'day expats and welcome to another episode of Expat Chat, episode 144 today. And today you've only got me as the Dubai office has gone on the Eid holiday. Very short notice as they usually are with that public holiday. But today, just myself, James Ridley, Managing Director for the Australian office, focusing on the Americas and the Asia Pacific. And what I wanted to talk about today is a bit of Q&A that we received in the Australian Expat Financial Forum Facebook group, as well as that recent announcement about the big, beautiful bill that is running through the US at the moment. There's some scary tax legislation pieces within that one that will affect all different types of expats that are working in the US. So I thought I'd touch on that a little bit and see if I can bust any myths. But we are still waiting on a lot of news on that one right now. They still need to get it through the Senate and then it needs to go to the conference committee, which actually fleshes out the legislation before the president signs off on that one. So I'll do a little deep dive on that one as well as the Q&A. But before we get into it, just a quick disclaimer. Anything that you hear today should only be consumed as information and entertainment purposes only. It's not and should not be construed as tax financial advice or personal financial advice, just general in nature. If you do need advice, please reach out to the Atlas Wealth Group where we can assist in a lot of different aspects. So kicking in it today. Now, recently there has been that big, beautiful bill that has been introduced over in the United States. It has already passed the House of Representatives, and right now it is in the Senate being debated on. What is probably the scariest part of that is the 3.5% excise tax on remittances that would be sent out of the United States. So the way that operates right now is if you are working and living in the United States as I suppose, a short-term visa worker, which for a lot of Australians would be an E3 visa, an L1, a H1B, or even a green card holder. If you were to send money back next year, as of the 1st of January 2026, when the legislation is meant to apply, they would tax you at 3.5%. So as an example, sending home 100,000 US dollars, you would actually only be sending $96,500. So it is concerning that anything that you're making that you're already paying tax on, you're then paying tax on it again. So it is going to disincentivize a lot of investment in the United States. But not only that, this is going to apply to a lot of other areas within the US. They are seeing that it will apply to restricted stock units. So these are RSUs or shares that you receive as part of your employee compensation when you're working in the US. It will apply to dividends, rental income, sale proceeds as well. And sharing a bit of, I suppose, information, I had the fortunate pleasure of connecting with Timothy Sandrossi from OFX early in the week, just to see if he could shed any light on what this means for currency providers, not just OFX, but I suppose TransferWise and other ones. And right now, it's their understanding that they would actually have to withhold the 3.5% based on their US account and US business on anything that would be sent back to Australia. And that is all very new to them because currently they don't need to send any tax to the IRS. So it's a completely new system requiring new technology and new software, which a lot of the remittances and a lot of the qualified remittances that would have to hold the 3.5% amount haven't set up just yet. So that is a bit of a concern. So it will be capturing non-citizens. The other side of this 3.5% US excise tax is that US citizens and those with a valid social security number shouldn't be caught by this. And some remitters will actually ask for verification. They haven't obviously laid out the details of how you're meant to provide that verification. But they have also said that in the event you are a US citizen or say a dual national and you get captured by the 3.5%, you can actually apply and use that as a tax credit when you are lodging your US tax return. So even if you're not living there, but you're still captured by it, you can apply for a tax refund, a tax credit is what it's been called. So bear that in mind that if you're a dual national or a US citizen that's no longer living in the US and you're sending money home and you're getting caught by this 3.5%, They have said that you receive that as a tax credit, which therefore would mean when you lodge your tax return, ideally you're getting a tax refund on that tax credit, that 3.5%. One thing that isn't clear within the legislation, within the Big Beautiful Bill, is the meaning of residence when it comes to the 3.5% US excise tax. So that is also probably one of the biggest concerns right now, where it's meant to apply for those that are working in the US and sending money overseas, but it hasn't deep dived or provided any guidance on whether it would apply to you if you are a non-resident and you have assets in the US, but you're a non-resident of the US. So a good example of this would be expats working overseas in the Middle East, Singapore, Hong Kong, where it might be, anywhere outside of the United States, but they receive their restricted stock units or shares or some sort of component of their compensation in the US, and then it's sent over to them. So that's something that they need to get clear on, whether that means that they would have a 3.5% tax withheld on that type of compensation, such as the restricted stock units. So that hasn't been fleshed out just yet, and that is a concern. There are other concerns around using other platforms like international platforms, interactive brokers for one. I know that can be quite popular with a lot of different expats where they set up an IBKR account, they use it to invest on the US share market. And then the concern there is that if this US excise tax is legislated, does that mean that anytime you want to pull funds out of your IBKR account and transfer it back to another account, would that mean that you're paying the 3.5% tax as well? So that has not been fleshed out just yet, and they need to provide further guidance on the meaning of residence. So it's something that we are keeping a very close eye on, and it is very concerning, the fact that they would try and run this through, because it is going to disincentivize a lot of investment in the US. And if it is legislated in its current form, it would make sense that a lot of Australians working and living in the United States, if they are sitting on large amounts of savings in the US, that they might look and choose to send that money home before the end of this calendar year, 31st of December 2025, to avoid the 3.5%, especially while the exchange rate is considered quite strong still when we look at the historical trend. So that is something to bear in mind. The other tax which was announced, which is under the Section 899, is what they're coining, I suppose, the retaliatory tax. And essentially it's increasing the withholding tax on things such as dividend income. That's probably the best example, actually. Right now, depending on the double taxation agreement that exists between the expat and the country, if it's Australia, it can commonly be between up to 30%. That is the most common withholding tax amount. With this Section 899 retaliatory tax measure, they are looking to increase that withholding tax up to 5% each year and taking it up to 50%. So over obviously the next couple of years, it would slowly increase to 50%, the withholding tax on the income distributions or dividend income from share style investments. So that is, again, concerning that they would look to ram that one through, because, again, that is disincentivizing people wanting to invest within the United States. So another concern, and that's why us, as well as many different cross-border tax advisors, are keeping a very close eye on this, because it's not going to apply to just Australians. It is going to apply to a lot of expats working in the United States. So a big concern there. Now, we'll move on to a bit of Q&A, which has happened within our Facebook group. So first one from Chris: where do I establish a will if I have left Australia permanently and have no fixed assets in Australia apart from a bank account with some money? Does the will get drawn up in the new jurisdiction? So that's an interesting one, and it's a tough one. Chris, the most common asset that we usually have is superannuation as well. So we want to make sure that your super has a binding death benefit nomination. That's probably part one, and everyone needs to have a BDBN on their superannuation accounts to ensure that the beneficiaries are on there. Otherwise, it'll go into the state, and the state has to work it out. Having a will to govern your assets is always really important. If we are in a different country, such as the UK or the US or anywhere else, if you are going to accumulate assets in that country, that it's also important to have a local will. especially if we're in the Middle East. We want to make sure a will's in place and it's registered in one of the local zones. That way Sharia law doesn't apply. So just bear that in mind. If you have assets in your new country that you've been living and working in, such as property, shares, maybe retirement accounts, it is important to have a will that governs those assets, as well as a will back in Australia to govern the Australian-based assets. And ideally, they work collectively together. There is no real such thing as a world will. It's mainly individual wills within the country as well. So that's important. Question here from Sharon. About the 3.5% excise tax on remittance. Yep. I feel like I've addressed that one. That's a really good question. It's something we're watching very closely at the moment because there are certain pieces within that legislation that they need to flesh out, and that won't happen actually until after it's passed through the Senate, especially the meaning of residence. So that's an important one. Naz has put a question in here. Hello, just wanted advice if expats are better off investing in property or shares in Australia? It's a very broad one, Naz, and it's a really good question, and it actually does come down to your individual circumstances and often what your goals might be. Both have their merits. Um, Unfortunately, property does lose some of its shine because you miss out on some tax concessions when you're living and working overseas and you're a non-resident of Australia. That extends to the main residence exemption. Sorry. It also extends to the 50% CGT discount concession. And often when we sell a property, we're also caught by the foreign resident capital gains withholding tax of 15% as well, and that's on sale when we are a non-resident. Different states also have different rules around land taxes and I suppose absentee taxes as well, and that's obviously covered under the land tax. So it really just depends. Property is also something that allows you to gear it. You know, you get a loan. You put the deposit together and then you go out and you're getting a gearing effect and compounding effect on that. But it is just something which you don't receive the same kind of tax concessions on. Conversely, we look at shares in Australia. Whilst you're a non-resident, they are tax-free in Australia, so that's really attractive. And what I mean by tax-free is as the portfolio grows with capital gains or unrealized gains, I should say, that is tax exempt in the eyes of the ATO. And then dividends can be exempt as well, depending on the type of dividends, depending on the type of investments within that kind of portfolio. Very often there's some withholding taxes which will apply based on the dividends being, say, unfranked or maybe partially franked. But dividends, conduit foreign income, interest income, as long as there's withholding tax coming out, it means you normally don't have to report that further in your individual non-resident Australian tax return. But the fact that shares can be tax-free on the growth is very appealing and provides a lot of flexibility in the event you need to tap into that capital for emergency circumstances or later in life when you might want to use those funds on, say, a deposit on re-entry for a investment property or a main residence. So it really just depends on what your goals are and maybe how long you're going to be overseas and what your surplus is as well, if you're saving an amount each month. So need to dive a little bit deeper on that one. Another question here, and it seems to be a common theme around the big, beautiful bill. It's my understanding, correct, that for Australians who own US domiciled shares, one implication of Section 899 introduced as part of the One Big Beautiful Bill is that their dividend tax and CGT could increase as much as 35%. So that's a good question. So the rate that they have proposed, especially on dividends, is that currently it's a standard withholding tax amount of 30%, but they have stated that each calendar year after that, it increases by another 5%, taking it all the way up to 50%. So it goes above 35%. It goes up to technically 50%, but that is essentially 4 calendar years after its first year of legislation. And that is what is very concerning. And that's why this bill is a bit strange because it really does disincentivize investment in the United States. And I guess this is why it is a big concern. It's a type of retaliatory tax as well that Trump's put through. And it's mainly centered around the fact that a lot of American companies tax potentially punitively in other countries where their businesses are based. So this is a bit of tit for tat, but Right now, it's not legislated. It has to still go through the Senate, and then it's the conference committee's, I suppose, role to lay out the legislation a bit more specifically, so we understand how it will be applying to all these different types of assets and income sources, and then whether it's applying to non-residents and non-resident aliens that actually have never lived in the US, but they just hold investments on, say, US platforms. So we will be deep diving into that as soon as we know more. Another question here about estate planning. Recently, I'm due to receive an inheritance, and a colleague of mine has said I need to do some research and seek advice regarding CGT event K3. Is it true I will be paying the tax when I receive the shares, or is it something that the executor has to look after? That's a really good question. So it really depends. Typically, so for those that are listening in, CGT event K3 is a bit of a unique tax event that takes place when a non-resident receives a parcel of shares as an inheritance. Because a non-resident is treated as a tax-advantaged individual or vehicle, it means that tax needs to be paid, and a CGT event is actually triggered, the sale of those shares, when the individual has passed away. So that's actually the taxing point, not when they receive the actual inheritance. So it can cause an uneven and maybe inequitable distribution of assets because someone in the family might be a non-resident, whereas everyone else might be a normal Australian tax resident. So it means that on K3, CGT event K3, there is going to be some tax on that one, and it's only applying to direct shares. That is the most common form of asset that it applies to. It doesn't apply to real property, such as an investment property, but it would mean that traditionally the executor would need to do the day of death tax return, and then that's when actually the tax would be due on that K3 CGT event. You do need to seek some really good tax advice when they are doing that tax return, just so they have a clear understanding of how it should be treated, given that you're a non-resident and the other beneficiaries sound like they are normal Australian tax residents. So that does need to be worked through slowly and methodically. That's an important one. That's all it is today, ladies and gentlemen. Thank you for tuning in on another episode. A bit of Q&A there, a couple of updates on the US excise tax, and those that are looking to join us on our next webinar, which will be taking place next week, we'll be covering off on US taxes, currency movements, as well as how to plan and obviously deal with cross-border finance and financial planning concepts when you are residing in the US. So keep an eye out on the socials. That is our next one coming up. And in the meantime, we look forward to seeing you on the next episode.